On an overall basis, the private equity venture capital investments in India appear to be on a good trajectory. This is the third quarter where we have averaged over $13.5 million on the trot. This is about 60% more than what we had seen in the third quarter of 2022. If you look at 2022, the first two quarters were really good, where we were averaging about $17.5 billion across these two quarters. In 23 calendar year, for the first three quarters, we have been more or less between $13.5 to $14.5 billion. Going forward, the outlook is positive, given the recent pause by the Fed, indicating a peak as far as interest rates are concerned. There is a lot of uncertainty around a lot of global macro factors, which we will get to on what's really affecting sentiment of international investors when it comes to making long-term FDI bets in India. If we peel the onion on what's really driven this growth in third quarter PE/VC investments vis-a-vis last year, you see that it's largely the pure play PE and VC investments, that is excluding infrastructure and real estate, which have really grown. They have grown by almost 88% above what was seen in the third quarter of last year. This 88% growth in pure play PE/VC investments is largely on the back of large deals, that is deals greater than $100 million. In the third quarter for calendar year 23, we had 31 such large deals aggregating to almost $11 billion, compared to just 15 large deals in the third quarter of calendar year 22, which aggregated to only $4.5 billion. If you look at it by investment strategy, growth investments were the highest at around $4 billion, followed by buyouts at $3.5 billion. From a sector point of view, infrastructure was the top performing sector this quarter, attracting almost $3.9 to $4 billion of private equity venture capital investment. Every month, we put a spotlight on one sector which is important for the private equity venture capital asset class. And this monthly, we have focused on the life sciences sector, comprising of pharmaceuticals, medical devices, and healthcare. This sector has emerged to be an important and attractive sector for private equity investments. Since 2018, this sector has attracted almost $22 billion of PE/VC investment and shown a CAGR of almost 24% over the last 5 years. When you look at the numbers, you can almost divide it equally between pharmaceutical sector and the healthcare sector, which would consist of hospitals, diagnostic chains, fertility, mother and child, so on and so forth. In the pharmaceutical space, a lot of investment has come into the API side, where private equity has not just bought out large businesses, but have also adopted a platform strategy, wherein they buy one large company and then look to bolt on smaller companies, eventually increasing the overall size of the business during their hold period of 5 to 6 years. As far as healthcare is concerned, we have seen large exits as well as investments, a lot of secondary deals in the healthcare sector, comprising of hospitals, comprising of fertility, as well as diagnostic chains, as I said earlier. One of the key things that's driving interest is not just the fact that the overall macro of India, the demographics of India lend themselves very well to this space, but also sea change that has happened post-COVID, where the common Indian population is ready to spend a lot more on their own health and the health of their family and the near and dear ones. The other thing which is driving interest is in the sectors is that private equity has managed to make very good returns on the back of controlled deals and growth capital deals in the pharmaceutical as well as the healthcare sector. Till now, most of the PE/VC investment in life sciences has come into pharma, and within pharma, largely API and formulations businesses, and on the healthcare side, in hospitals. Hospitals have almost accounted for 62% of the overall PE investment that we have seen in the healthcare sector. But there are some interesting new trends emerging. Going forward, we see a lot of interest in biotechnology, in medical devices, in health tech, which going forward is going to increase the momentum of investment into this sector by the private equity and venture capital investor base. At $8.6 billion across 85 deals, Q3 has been the best performing quarter for PE/VC exits over the last 7 quarters. Almost 44% of the overall PE/VC exits are contributed to by open market exits, wherein private equity has taken advantage of the buoyant capital markets and have exited in part or in full from their positions in publicly listed companies. The second largest source of exits at $2.3 billion were basically secondary deals, wherein one private equity fund has sold its stake to an incoming investor who is ready to hold on the risk for another period of 4 to 5 years. The fact that exits are rising, the fact that capital markets are buoyant, notwithstanding the volatility and the uncertainty we are seeing around us globally, is a very, very positive sign. Exits matter a lot to private equity as an asset class, and it's really good to see them going from strength to strength in this calendar year. Key sectoral themes which seem to be emerging from renewed private equity interest is in industrial products, financial services, healthcare, and retail and consumer. This is over and above the other asset classes of infrastructure and real estate, which continue to see sustained investment activity from private equity and venture capital investors. At EY India, we not only have the largest investment banking team, but also the largest due diligence team. This gives us a very differentiated point of view on the pulse of the deal pipeline. And our view is that things are looking positive. If we combine this deal pipeline with the emerging Indian macro, which is looking increasingly positive on the back of record GST collections, record advanced tax collections, and the rise in consumer confidence as we get into the festive season, we believe that Q4 could be the best quarter for PE/VC investments for calendar year 2023. However, all these positives are being increasingly counterweighted by a deteriorating global geopolitical situation, wherein not just the conflict in Europe, on the eastern parts of Europe, but also the new conflict which has emerged as a hotspot in the Middle East has suddenly added to a lot of global uncertainty. The Middle East conflict, if it expands, could potentially impact the energy markets, and any sustained spike in crude oil prices would be detrimental for the health of the overall Indian macro situation. While the startup sector is struggling to get investments, the other parts of the economy with growth investments and buyouts appear to be on a boil, along with significant interest in PIPE transactions. The buoyant capital markets are allowing for more exits by IPOs from PE-backed companies, and all this lends itself into what is emerging as a much more positive environment as far as PE investments and exits are concerned. We remain cautiously optimistic that 2023 will be much better than 2022, and of course we remain bullish for 2024 and 2025 as the long-term story for Indian private equity continues to remain strong.